Hi, you're listening to Avenue Insights. At Avenue, we often talk about important events affecting clients, from the economy to Canadian and US politics to what's happening with the stock market. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based on information available at the time and are subject to change without notice. In episode 3, Matt Manara and Bryden Teich discuss the US federal deficit and how it's impacting the direction of monetary policy. They also discuss the reach for yield going on in corporate and high-yield bond markets and discuss other risks they are seeing in the market.
So one of the places I thought that we could start today's conversation is this topic of liquidity that we've talked about regularly in the office. The last several months, obviously, central banks around the world are providing so much liquidity into the market, and it seems like stock markets are definitely taking their marching orders from what central banks are doing. And so, from what you're seeing, what's the feel in terms of what markets are doing, and what kind of impact are you seeing from that liquidity from central banks?
Well, that's a good question, and I think the average person still doesn't know what it means when you say central banks are adding liquidity into the system. But and we'll get back to that. But what are we seeing out there? You're seeing this liquidity-driven, momentum-driven market on one side of the equation, where you see some stocks out there or sectors that are going completely parabolic. Even, for example, Tesla, which has, I think Elon Musk has made $20 million an hour for the last 2 months on a company that loses $5,000 a car. And then on the other side of the equation, you're seeing deteriorating fundamentals, including the whole U.S. economy in aggregate. You're seeing declining earnings growth, and we can also get into that.
Yeah, no. So I think that's a good place to start. So the last number of months, I think focus on the market has been on when was the U.S. and China going to reach a trade, a phase one trade deal, and it's amazing how with all the rest that's going on with the coronavirus, with the Fed-driven liquidity, all of a sudden that phase one trade deal seems so much farther in the rearview mirror. But at the same time, to your point, if you look at manufacturing and you look at sort of the more industrial side of the economy, still hasn't. It doesn't feel like it's turned the corner in that respect. So to your point, the underlying fundamentals are still a bit soft. And then if you layer over that the coronavirus and what that's going to do to Chinese growth and then also global growth, there's still a lot of murkiness out there with regards to what the fundamentals are going to say.
What really struck me and caught me off guard was not only with the coronavirus, you have the second largest world economy that's effectively being taken offline, but you had that one day, a few days ago, the Chinese market was down 9% in one day, and the S&P opened up positive with some momentum. And I think that tells you everything that you need to know about this momentum, liquidity-driven market that's not trading based off of fundamentals.
Yeah, and I think to that point exactly, the Sunday night, North American time, China was down 9%. I think we all came into the office Monday morning expecting, markets to be down here in North America, and what happened, both the TSX and S&P were up, significantly. And I think it also speaks to the point of the amount of liquidity being thrown at the market, whether it's in China or whether it's in the US. The dips become so shallow because as long as money's being pumped into the system, then there's always going to be a bid to asset prices. And I think that theme has now really, really taken, I think, the core focus of a lot of investors. And, but at some point, obviously, fundamentals do have to matter and earnings have to matter. And if you don't have fundamentals improve, it seems like, the market is not really reflecting what the underlying economy is doing.
Well, that's exactly it. And let's take a step back for a second. We keep on using this word liquidity. For our listeners, let's talk about what that means, and specifically, let's talk about the repo market. What is it in a very general overview, Bryden? What is the repo market? How is liquidity or money being injected into the system? And what does it mean for your average investor or, furthermore, your institutional investors out there?
I think when we've explained this before to clients, and just talking, to ourselves about it. I think the easiest way to explain what the repo market or the repurchase market is that it's basically the same. The same way to think about it would be it's the overnight plumbing for the financial system, and so it's a place where banks and large institutions lend to themselves for very short-term money, and specifically what happened in September is the overnight interest rate spiked up to, for a minute, 10%. And I think that sort of was the first earthquake that sent a tremor into the market. And really what it signals is that there's not enough liquidity in the system, especially the very short-term funding markets. And so to your point, what the central bank's been doing since then is the Federal Reserve in the U.S. has been buying $60 billion a month of Treasury bills, and at the same time doing both 1 and 2 day repos, and then also a shorter term repo, which say is like a week or 14 days. But from September to now, if you look at what the Fed balance sheet has done, and also what the stock market has done, the correlation I think is close to one, 1 or 0.95 as you can possibly be, meaning that as the central banks expanding their balance sheet, stock markets have gone up. And so I think the Fed had a meeting last week and they held interest rates. And it sounds like for the time being, at least through the end of tax season, so into April, they're going to be supplying this liquidity. But I think the bigger question is, with the size of U.S. spending being so significant at almost 5% of GDP, the bigger question is, does the liquidity have to continue for longer because of that size of the federal deficit?
Yeah, and it doesn't matter if you're Republican or Democrat or what your political views are. So if you're a Democrat and let's say Bernie Sanders gets into power, you forgive student loans, you have universal health care, or the Republican side, whether it's military spending or tax cuts, neither the Republican Party or Democrat Party is being responsible financially in the context that they need a record amount of debt to fund their platforms. And it's neither party's fault, because you're talking about 30, 40 years of government overspending, entitlements, defense spending,
under taxation
that has led to this problem. And there's consequences to this.
Yeah, I think one of the most telling charts that we've looked at in the last couple of weeks has been, if you look at the federal spending in the U.S. as a percentage of GDP, and if you go back 50 years, and the level of federal spending right now is 5% of GDP. So simple math is the U.S. economy is about 21 trillion, and the deficit spending is about just over 1 trillion. So 1 divided by 20 is 5%. But if you go back and look at previous recessions, so in the 1970s, the 80s, and early 90s, the level of spending today fiscally in the U.S. is at the same level as the troughs of the last recessions, in the depths of what you would call Keynesian stimulus. But we're in a world where the narrative or the perception is that we're in a very strong economy, and so I think that's the underlying thing that people, almost the third rail that the Fed isn't really talking about, is that in the U.S. government spending has been out of control. And then if you layer over that, this idea that's changed the last number of years is that foreign central banks have also stopped buying U.S. Treasuries en masse.
That is amazing to me.
And it's a huge. They've been a huge buyer for a long time. So maybe talk a little bit about that dynamic.
Yeah. So as you know, the government is doing massive T-bill issuances, and the U.S. dollar is a reserve currency. 80% of global payments are in U.S. dollars. But the amount of money that they need to raise, there's not even enough liquidity in the whole financial system for various countries to even buy these issuance, nor do they want to at the rate that they're borrowing money. It's not worth it at a sub 2% type interest rate, and you have the U.S. that has weaponized the dollar essentially, whether it's through tariffs or policy with Iran, and you have foreign governments saying, well, you know what? First of all, I don't have enough money to buy all of this. Secondly, the U.S. is weaponizing the dollar. Why don't I buy gold? Why don't I buy euros? Why don't I buy anything but the US dollar? And you're seeing that trend continue, which is incredibly scary to me.
Yeah, I think the underlying reason also that, to your point, of why they're not buying treasuries in the same level is both the fact that the U.S. is in some ways weaponized the dollar, but also you had 20 years of rising trade surpluses and capital surpluses in all of these of developing countries, and so when you're running a capital surplus, the easiest thing to do is you take that money and you buy U.S. treasuries. And so all of global central banks had done that for a number of years, and now that trend has reversed in the last several years, say 5 years specifically. And so, but that brings us back to this idea of what the Fed is doing, and they're having to supply all of this liquidity in the T-bill market because the record amount of U.S. issuance is just so significant.
And if you're to clear this at a normal interest rate and you're not pumping the liquidity, you're pumping into the system, it would be high, whether it's 5, 6, 7%. And if interest rates spike, you throw the whole world into recession or depression on one side of the ledger, and on the other side of the ledger, you have a Federal Reserve that has to keep injecting capital into the overnight lending markets or the stimulus to keep it going, to keep things going. And whether you hear these words, quantitative easing or monetizing the debt or repo lending, all it means is it's a nice way of saying, I can't pay you back. And we're going to print more money, and we're going to continue to try to inflate our way out of this. And the average guy does not understand why his purchasing power or this cost of living seems much higher. And not to talk about history or politics, but you go back through any period of time where you've had waves of populism, there's a direct correlation with inflation.
Right, like people's cost of livings have been higher, and then there's the everyday person feeling the pressure, of the cost of living going up, and yeah, totally agree with you on that. The one thing is, if we switch directions a little bit and say, so we're in this world with lots of liquidity being supplied, with record low interest rates, and obviously, the knock-on effect of that has been there has been this reach for yield, both in credit markets, the high yield market, stock markets for that perspective as well, and so. From specifically, if we switch and look at both the credit market and the high yield market, what are you seeing in terms of that reach for yield and people's demand for anything that yields like an income stream? Yeah. But it's changing the dynamic in the corporate bond market, I think, pretty significantly.
First of all, half of the world is in negative interest rates, and you have billions of dollars, pools of capital that need a rate of return. And you've seen this chase for yield, and what we're seeing specifically in the corporate bond market or high yield market is you're seeing all of these issuance, even with not the greatest credit quality, being bid up. And I don't want to mention any names, but there was a new issue that just came out recently
in Canada.
In Canada, the credit is lousy. It's not backed by any assets, and the deal is oversubscribed. And we're faced with a situation where you're saying, well, I can buy my client's junk and get 5%, but it's not secured by assets. The credit rating's not good. Or I can have a little bit more of a cash waiting until I wait it out. But the one area of the market where we are seeing a few opportunities that institutions can't take advantage of due to their size is the convertible bond market.
Oh yeah, that's actually a good point. I think the unique thing about the Canadian bond market is that because of a lot of the size of our companies in Canada, a lot of them don't want to have to pay the rating agencies. So, Moody's, S&P, Fitch, DBRS, they don't want to have to pay them to get rated. So they end up then defaulting and saying, well, I can issue convertible bonds, and there's a liquid convertible bond market in Canada. And so the size of the issuances are smaller, but at our size, we're able to, find very attractive yields in the convertible market where we're getting, 5, 6, 7% on a convertible bond. And at the same time, you have the embedded option in the stock that comes along with the bond. So if the stock gets to a certain price, that bond converts then into equity. And so there's a nice asymmetry to that for what we're doing. And we're able to get the yield be comfortable with the credit, and then have the same optionality on the equity. And the one thing I'll ask you is that we've seen a lot, over the last number of years, is a huge rise in the issuance of preferred shares. And so, a lot of people, I think, sometimes think that preferred shares are a fixed income substitute. And so what's your view on the preferred market, and what are some of the things you're seeing there?
This absolutely drives me crazy. First of all, the preferred share market is really a retail phenomenon. So whether it's RBC or the TD or the bigger banks have issued over the last number of years billions of dollars in these preferred share issues, which is really important to make the distinction between preferred shares and fixed income. Fixed income, as you know, you're lending money, your creditor on the assets, they have to pay you back. Preferred shares do have some fixed income characteristics. One, you have a fixed dividend payment versus a fixed coupon. You're higher up the capital structure on the equity side, the preferred share, but versus the common share, but it's not fixed income. So just to clarify even further, if a company becomes insolvent or goes through a period of distress, the common shareholders or preferred shareholders' equity is usually not worth anything. If you're a bondholder and you have a claim against the assets, you're lucky to get paid 75 cents or 85 cents on the dollar. So the moral of the story is preferred shares are equity. They're not fixed income, although they have a fixed income characteristics. And the other issue is, since these issues are smaller in size, there's not a ton of liquidity, and the banks have issued these quote-unquote sexy features, so rate reset preferred shares. What does that mean? Well, a lot of advisors did not know how to articulate the risks adequately to their clients, and you were at a point in time in 2017 where interest rates were starting to go up. So investment bankers thought, okay, you issue these things. If you have a rate reset preferred share, all it means is every 5 years or after a certain time period, if interest rates go higher, we'll revise your dividends higher. But really what happened is interest rates went the other way. So a lot of retail investors that have preferred shares that they thought were fixed income, rates continued to fall. You had these dividends that were reset lower, a lack of liquidity, and they're down 15 to 30%. And once again, you have no claim on the company's assets. You are not a creditor. You're not a bondholder. You can obviously make the argument that preferred shares can have its place in the market, but not to mention advisors making generous commissions of 2% upwards on these type of things. But sorry for the rant.
No, that was good. I think the other thing to your point is that once on a rate reset preferred, once the shares collapse and the dividend is reset to a lower level, the unfortunate reality is at that point, I'm sure a lot of the common stocks are actually then yielding higher than what that preferred is. So you lose, it's not even you lose the income and, let alone the capital loss as well.
Yeah. And the other thing is, not to get too complicated, but if a new issue comes out with the reset preferred that with better terms or sexier features, that also affects the resale market and how it's valued.
Right. Because everything gets priced off of each other.
So the risks and dynamics are not understood versus a client lending money to a Bell Canada or an Enbridge and saying, here, we're going to lend you money for 3 years or 5 years. Enbridge is going to pay me back. And if they don't, I have a claim on their assets.
Yeah. I think the other place too, I mean, the one also term you mentioned was illiquidity of preferreds. But if we look at what's been going on in, say the private equity and then also the venture capital space too, is going back to your earlier point of saying, Japan and Europe are both zero interest rates. So money around the world is searching for a positive yield or a positive return anywhere. And so you've seen a lot of money go into, private assets or private credit or private equity or venture capital as well. And so maybe speak to that dynamic a little bit and some of the sort of the risks that you see going on in that space.
Yeah. So, okay, we can talk about it in a few different ways since we're already talking about fixed income. one of the things that I'm seeing in fixed income portfolios is that need for yield, because interest rates are so low. The bond market doesn't pay you that much. Like you said, half of the world is in negative interest rates. So you're going up the risk curve and saying, well, I can buy a private mortgage that yields higher. I can buy foreign denominated bonds in China that pays higher. I can buy a preferred share that gives me a higher coupon. I can buy anything that is not fixed income or high yield debt that's not credit worthy to get that higher yield, and investors don't realize they're going right up the risk curve. But more specifically about private equity in general, you're seeing billions and billions of dollars out there, capital looking for a home, and this whole sales pitch saying, well, you can buy private real estate and it has a lower correlation to public markets. It's not correlated. It's less volatile, and you can earn a better rate of return. Well, in some respects that's true, in other respects it's not true. So, for example, you're seeing tons of money go into private real estate, and real estate is correlated to equity markets, or REITs are correlated to equity markets,
toward the economy.
But if you calculate the NAV once a year with who knows how they're calculating it, whether it's an arbitrary or more standardized formula, but that once a year NAV doesn't mean that it's accurate, number one, and number two, that doesn't mean you don't have a correlation to the equity markets. If you owned an apartment building and you were to price it daily, it would just be as volatile as any other REIT or real estate component,
or change in the discount rate,
change in the discount rate. And the other thing you're seeing is because of attracting the amount of capital into these spaces, you're actually seeing private equity valuations on the real estate side, for example, that are more expensive than buying a REIT on a public market REIT. So that's just one issue. And
I think the other thing too, just on to piggyback off of that, is we talked about this, I think, maybe 2 or 3 quarters ago in the case study about looking at the perfect example of the private equity market going awry is WeWork, and the valuation collapsing before the company tried to go public. You had the CEO have to leave, and I think that is the poster child for what low hurdle rates for investment look like. And so maybe speak to that aspect too. Have you seen a year of record IPOs in the US, but a lot of that private capital has gone into businesses that actually aren't doing as well as what the stock market is showing you? Yeah,
so WeWorks is a great example, but you're just seeing this continued push to value assets higher. It's like saying this: if Enbridge was a private company, it's probably worth $100 a share. But that doesn't mean that the market can bear $100 a share. It's worth $56 a share. So you can say it's valued at whatever you want. You can attract all kinds of capital. But when you go to IPO, the market might tell you something completely different.
Right, which also goes back to the idea that markets are actually far more efficient than sometimes people realize. And markets also don't take any prisoners. And it's just a function of being priced every day when you own securities. If it's a corporate CEO trying to say, oh, my company's worth X, and it's whatever the people on the exchange trading your stock says it's worth. It's not what you think it's worth, or it's not what your private multiple of cash flow or your EBITDA or whatever that number is. And so I think, the valuing or valuation on private assets is also, it's very not transparent. And so I think that's, where a lot of these valuations have just gotten out of whack.
And one thing that we haven't added to that is also the amount of leverage in private equity.
Right.
The growth in private equity, a lot of it is also on the debt side, where you're using a lot of leverage and you're valuing it based on whatever formula. And when you need liquidity, or markets go the other way, or the economy goes the other way, and you need some form of liquidity, that there can be a real unraveling, and this can be a real mismatch even for institutions trying to match up with their liabilities and liquidity requirements.
Right. I think that's the concept of leverage too is interesting, because when you have a private equity fund or a private asset pool, you can apply leverage to it and make returns look really fantastic. But at the same time, fundamentals of whatever you're investing in eventually have to hit, the rubber has to hit the road in terms of what you're investing in is actually worth, that cash flow or that earnings out even 5 or 10 years. But I think, the underlying theme of being in a low interest rate world and this reach for yield or stretch for returns has led to, a number of years of malinvestment because
on the equity
money's been free.
Yeah.
Basically.
So one thing people are doing is you end up buying riskier equities, common shares with higher dividends, and you effectively end up buying a company that there's something wrong with. Obviously, there's exceptions to that, and there is anomalies at times in the marketplace. You see the pools of capital going into private equity leveraged. You see it going into foreign bonds or private mortgages. You're saying, just give me a rate of return that's better than the interest rate, and I will do anything in my power to bid that up. And the investor does not realize how far up the risk curve they've gone. So it doesn't matter if it's a preferred share, rate reset, doesn't matter if it's a high yield bond, doesn't matter if it's a dividend yield at 10% where the market's telling you something's wrong with this company. Maybe there isn't something wrong and you've done your analysis, but they're few and far between.
So if we go back to the underlying theme that we started off with, looking at the liquidity being supplied by the Federal Reserve and, liquidity being pushed into the system from global central banks. But what's your view on, how long this can continue and how long you think fundamentals and, stock prices can be divergent? And do you think that the outlook for the Federal Reserve for the next, the balance of this year into an election year, at that, do you think they're going to continue being forced to supply that liquidity?
Yeah. So I think you don't have a choice. The Federal Reserve is going to be effectively forced into printing money and injecting capital into the overnight system because you have record amounts of debt where foreign governments are starting to walk away from. They do not have enough liquidity on their own or the size or scale to be able to buy the amount of debt that needs to be issued. So the Federal Reserve is going to continue to buy it. And if they take liquidity out of the system, well, we know what happens. When you're in a raising interest rate environment and you're starting to take some liquidity out of the system at the end of 2018, December, you saw the S&P drop 20%, although it was briefly, and then the Fed reversed course and started cutting, and then you had this repo issue in September and the printing that's going on. So I think central banks are aware that they have to keep printing money because you're not going to be able politically to start taking things away from people and say, well, we're not going to provide the social services we provide, or we're not going to do anything, any of these entitlements be taken away. And even if you did, it probably doesn't matter much now with the debt level. So, but to the second part of your question, or maybe it was the first part of your question, so how long can this go on? Well, any market, bull market, it always comes back to fundamentals. So you can be in a bull market where liquidity and momentum is driving the market higher and fundamentals are secondary, even if they're deteriorating, but that can't go on forever, but it certainly can push you past the point of comfort where you even say after this, this point in the market, you go, shoot, why don't I own these things that trade at 30, 40, 50 times earnings? And maybe it goes to 60 times earnings. It can certainly push you past that point of comfort, but you have to sit here and say, well, when you go back through time, there always is a day where fundamentals do matter. But with that being said, I think with this continued injection of liquidity into the system, you can really make the argument that asset prices, I don't care if it's farmland, real estate, income streams, gold, silver, asset prices continue to go higher over the next decade, and you run at a bit higher inflation. And I think it's going to lead to more political instability, more populism. You're already seeing it across the globe, and I think it's a real issue. So if you have a long-term time horizon, or you don't need, monthly or yearly liquidity, if you're retired to fund your life, really fixed income has become a bank account substitute almost, where you don't want to be in cash or bonds unless you absolutely need to,
Or you need that money.
or you need that money. But if you don't, it's hard to say, well, if I'm going to be putting this type of liquidity into the system, how is real estate not going higher? How is owning infrastructure in Canada not going, or across the globe, going higher, or hard assets? And
Yeah, I think the difficult thing, I think, on that note is that if they continue supplying liquidity, I think, I agree with that comment very much so. The risk is always that they actually don't supply the liquidity that the market needs, and you could have a very quick reversal. And so I think
Absolutely.
that's why I think, in the last number of weeks, we've raised a little bit more cash than we'd had previously last year, because even if that scenario plays out where central banks keep putting liquidity into the market, it's going to be a volatile, march higher. And so you want to be opportunistic with having cash on the sideline so you can deploy that, when the market does pull back.
So just to be clear, that's exactly right. So we can have this view and say, well, if they continue to keep printing money and injecting liquidity in the system because they have no choice, it looks fairly clear, but it always comes back to, what if you're wrong, and not operating in extremes when structuring a portfolio. And to Bryden's point, that's why we do have a little bit more cash than usual in the portfolio, because that bucket of high yield bonds, in good conscience, you can't go out and buy crappy credits not secured by any assets to get 5% rate of return. So you do run a higher cash. Or what we've done, you have increased your exposure to precious metals. You do have that infrastructure or real estate component. You still do care about valuation and doing your valuation work and having income coming into the portfolio each and every single month. And it also comes down to understanding your client's life and their personal circumstance, where if they need monthly liquidity or daily liquidity to pay their bills because they're retired or there isn't income there, well, guess what? You do have to have cash or be in the bond market. So we at Avenue, we try not to operate in any extremes and always take the negative view by saying what could go wrong here.
So on that note, why don't we wrap it up there? And thanks for the conversation, and that was great, and looking forward for the next one.
Excellent. I really enjoy the unscripted conversation and hope everyone was able to follow along.
I hope you enjoyed today's conversation. You can find us on avenueinvestment.com, where you can learn more about the topics discussed today at our blog, or subscribe for updates to our content. You can also follow us on YouTube, Apple, Spotify, Google, or wherever you get your podcasts. Thanks for listening, and we'll see you in the next episode.